Welcome to your Mortgage Minute by onlendhub.ca. Today we're discussing cash damming, a strategy Canadian rental property investors use to improve the tax treatment of their borrowing. But this is not a loophole or a way to simply relabel a personal mortgage. Mouli, what is cash damming?
Cash damming separates personal debt from investment debt. The investor uses a dedicated line of credit to pay eligible rental property expenses while directing rental income and available cash toward the non-deductible mortgage on the principal residence. The tax principle is based on the use and purpose of borrowed money. The Canada Revenue Agency says interest can generally be deductible when borrowed funds are used to earn income, and rental investors can deduct interest on money borrowed to buy or improve a rental property.
Give us a practical example. How does the cash actually move?
Assume a rental property receives $3,000 of rent each month and has $2,000 of eligible operating expenses, including repairs, utilities, insurance, and property management. Instead of paying those expenses from the rental account, the investor pays the $2,000 using a dedicated investment line of credit. The $3,000 of rent is then applied to the investor's personal mortgage. After 1 month, $2,000 of borrowing is linked to rental expenses, while $2,000 of personal mortgage principal has been paid down. Total debt has not automatically decreased, but the composition has changed. That distinction matters because interest on personal mortgage borrowing is generally not deductible, while interest on properly traced investment borrowing may be deductible.
Let's put numbers on the potential tax effect.
Suppose the line of credit balance is $2,000 and the annual interest rate is 8%. 1 month of interest is approximately $13.33. $2,000 multiplied by 8% divided by 12. If the investor's marginal tax rate is 40%, the estimated tax reduction associated with that month's interest is about $5.33. $13.33 multiplied by 40%. That is not a $5 profit. The investor still paid $13.33 of interest. The potential benefit is a reduction in taxable income, subject to the investor's circumstances and the tax return.
What happens as the strategy continues?
Assume the investor directs $2,000 per month to the personal mortgage for 12 months. That reduces personal mortgage principal by $24,000, assuming the entire amount is applied to principal. The investment line of credit reaches $24,000 if no rental expenses are paid down. At 8%, the annual interest on a constant $24,000 balance would be $1,920. At a 40% marginal tax rate, the potential tax reduction would be $768. But the actual result depends on the monthly balance, interest rate, eligible expenses, rental income, and tax position. Principal repayments remain principal repayments. They are not deductible rental expenses.
What is the first decision framework an investor should use?
Use a 3-part test before starting. First, identify the income earning activity. Is the borrowing connected to a genuine rental or business activity? Second, identify the exact expense. Is it a reasonable current expense incurred to earn rental income, or is it a personal purchase, capital improvement, or principal repayment? Third, prove the connection. Can every dollar borrowed be traced from the line of credit to the eligible expense through statements, invoices, and bank records? If any answer is unclear, do not treat the interest as deductible without professional advice.
What is the biggest red flag?
Commingling funds. Do not use one line of credit for rental, repairs, groceries, vacations, and personal purchases. A mixed account creates multiple borrowing uses and makes interest tracing difficult. A second red flag is borrowing for a rental property that is not operated with a reasonable expectation of earning income. A deduction does not transform a poor investment into a profitable one.
Give us another calculation involving rising rates.
Suppose the investment line reaches $30,000. At 6%, annual interest is $1,800. At 9%, it becomes $2,700, a $900 increase. At a 40% marginal tax rate, the additional potential tax reduction is $360, but the investor still pays an additional $540 after tax. The tax deduction softens the increase. It does not eliminate interest rate risk.
Who should consider cash damming and who should avoid it?
Consider it only when 3 conditions align. You have stable rental cash flow, enough borrowing capacity, and disciplined bookkeeping. Avoid it when the rental property is already cash flow negative, the line of credit is variable rate and near its limit, or you cannot maintain separate accounts. The strategy increases the visibility of investment debt and can leave you with a larger personal mortgage only if the plan is poorly executed. The second framework is simple. Act only when the after tax benefit exceeds the administrative cost and the investment remains viable under a higher interest rate scenario.
What should listeners do immediately?
Prepare a schedule of rental income, eligible expenses, mortgage balances, line of credit rates, and marginal tax rate. Ask a tax professional to confirm the proposed tracing structure before moving money. Then open separate accounts, retain invoices, download monthly statements, and never use the investment facility for personal spending. Review the plan annually, especially at mortgage renewal.
3 takeaways. Cash damming is about tracing the use of borrowed money. Tax deductibility does not mean borrowing is free, and clean separation is essential. The Canada Revenue Agency allows reasonable rental expenses in the calculation of rental income, but the facts and documentation determine the result. Thanks for listening to your Mortgage Minute by onlendhub.ca. Before implementing this strategy, speak with a qualified Canadian tax professional who understands your rental property structure. See you in next episode.